Your savings account just earned you $12 in interest last month. Congratulations, you lost $143. That's not a typo. That's not clickbait. That's the actual math when you account for what inflation did to the money sitting in your account during that same 30-day period. The number on your screen went up. Your ability to buy things with that money went down. And here's the part that should genuinely piss you off. The bank knows this. The government knows this. And they're both counting on you not doing the math. Right now, the average savings account in America pays 0.46% interest annually. Inflation over the past year averaged 3.4%. That means for every $1,000 you responsibly saved, you effectively lost $29 in purchasing power. Your balance says $1,012. The grocery store says that buys you what $971 bought last year. The wealth didn't disappear. It transferred. And we're going to trace exactly where it went. Because this isn't some abstract economics theory. This is a systematic extraction of value from people who are doing everything they're told to do right. Save money. Build an emergency fund. Be responsible. And the reward for that responsibility is watching your money quietly rot. Let me show you how elegant this scam actually is. When your bank advertises that savings account, they put that interest rate in huge numbers. 0.46% APY. Annual percentage yield. It sounds official, it sounds like growth. What they don't put in huge numbers is that inflation is currently eating 7 times faster than your interest can possibly grow. They're not lying. They're just showing you the number that goes up while staying very quiet about your actual purchasing power going down. Here's the thing about purchasing power. It's the only number that actually matters. You don't need account balances. You don't pay rent with percentages. You buy real things with money, and if that money buys less bread, less gas, less housing than it did before, your account balance is a meaningless participation trophy. Let's get specific. January 2021, you put $10,000 in a high-yield savings account. Responsible move. That was the recommendation everywhere. You found one of the better ones, paying 0.5%. Over 3 years, you earned about $150 in interest. Your balance is now $10,150. You did it. You saved. Here's what nobody mentions in those savings account commercials. Inflation over those same 3 years was cumulative 17.7%. To have the same purchasing power you started with, you'd need $11,770 in that account. You have $10,150. You're down $1,620 in real terms. The number went up, your wealth went down, and you get to pay taxes on that $150 of interest as if it was actually income. That's the first transfer. Your purchasing power transferred to everyone who got to spend money before prices adjusted. The government that printed it, the banks that loaned it, the corporations that borrowed at cheap rates and bought back stock. They all got to use new money while it still had yesterday's value. You got to watch your saved money buy less while the number on screen went up enough to make you think everything was fine. But here's where it gets genuinely weird. Banks are paying you 0.46% on your savings. What are they doing with that money? They're loaning it out at 7% for personal loans, 11% for student loans, 24% for credit cards. They're taking your money, the money they're paying you basically nothing to hold, and they're making anywhere from 15 to 50 times what they pay you. The spread is the scam. You give them $1, they pay you half a penny per year to hold it. They loan that same dollar to someone else and collect 7 to 24 cents per year. The difference is their profit. Your savings account isn't an investment. It's raw material for their actual business. And you might be thinking, okay, but at least my money is safe. FDIC insured. Can't lose it. True. You can't lose the number. But insurance against your account balance hitting zero is not the same as insurance against that balance becoming worthless. The FDIC insures up to $250,000 per depositor per bank. If your bank collapses, you get your $250,000 back. If inflation runs at 10% for 3 years, that same $250,000 buys what $182,000 used to buy. And there's no insurance for that. Remember that earlier math about losing $143 while earning 12? Here's where it bites. That's happening every single month you keep significant money in a standard savings account during any period where inflation exceeds your interest rate. And for the past 3 years, it's exceeded it by a lot. The Federal Reserve raised interest rates to fight inflation. Your credit card APR went up. Your mortgage rate went up. Know what didn't go up nearly enough? The rate banks pay you to save. The average savings account rate in 2008 was 1.7%. After the financial crisis, it dropped to 0.1% and stayed there for over a decade. Inflation during that time averaged 2.2% annually. For 10 straight years, every single person with a normal savings account lost about 2% of their purchasing power every single year. Compounded. The responsible savers subsidized everyone else. Here's the part nobody tells you. Savings accounts aren't designed to build wealth. They never were. They're designed to park money you need liquid access to. Emergency funds, short-term goals, money you can't risk in the market because you might need it Tuesday. That's the actual use case. But somewhere along the way, we started treating them like investments. We started measuring success by the balance going up, not by what that balance can actually do. Financial institutions love this confusion. They market savings accounts with words like growth and high yield and wealth building. A 0.5% return is not high yield. It's a rounding error. It's less than the average price increase on eggs. Calling it high yield is like calling a golf cart a sports car because it has a steering wheel. And the fees. Oh, the fees make this so much worse. 62% of savings accounts charge a monthly maintenance fee if you drop below a minimum balance. That fee averages $5. If you're keeping exactly the minimum, say $500, and getting 0.46% interest, you earn $2.30 per year. You pay $60 in fees. Your account balance goes down by $57.70, and inflation takes another $17. You paid $74 for the privilege of letting a bank use your $500 to make $35 loaning it out. The wealth transfer is complete. So what do you actually do? Because you do need savings. You do need accessible money. Emergency funds are not optional. Here's the honest answer. Keep 3 to 6 months of expenses in a savings account. That's the emergency fund. Except that this money will lose to inflation. That's the cost of liquidity, the cost of safety. It's insurance, not investment. You're not trying to grow this money. You're trying to have it available when your car explodes or you lose your job. But find an actual high-yield savings account. Not 0.46%. As of right now, multiple FDIC-insured online banks are offering 4.3 to 5%. That's nearly 10 times the national average. It doesn't beat inflation if we hit another spike, but it gets close. And it's real FDIC insurance. Same protection, just banks without physical branches passing the savings to you. Everything beyond your emergency fund should not be in a savings account. Not if the goal is building wealth. If you're saving for something more than 2 years away, inflation will destroy you at savings account rates. You need assets that have a chance of outpacing inflation. Index funds historically return about 10% annually. Even in bad decades, they average 7%. That actually beats inflation. Treasury I bonds are directly indexed to inflation, currently paying 5.3%, guaranteed to not lose purchasing power. Even CDs, certificates of deposit, are paying 5 to 5.5% right now for terms as short as 6 months. The point is optionality. Money you don't need to touch for a year should not be getting 0.46%. It should be working harder than that because inflation never stops working. Here's what this all comes down to. The financial system is built on the assumption that most people won't do this math. That you'll see the balance tick up $12 and feel good. That you won't calculate the $143 you lost. That you won't notice the spread between what they pay you and what they charge everyone else. That you'll think savings account means wealth building instead of short-term parking. And for decades, that assumption was correct. It made banks billions. It transferred wealth from the bottom and middle to the top so smoothly that nobody noticed the mechanism. The number goes up, everyone thinks they're winning, and purchasing power evaporates like water in the desert. But you can't unknow this now. You can't see your 0.46% interest rate the same way. You can't ignore that every month your savings sit there. Inflation is probably taking more than the bank is giving. The number might go up. Your wealth is going down. Your savings account isn't losing money. It's losing value. And the difference between those two things is everything. Move your emergency fund to an account actually paying competitive rates. Move everything else to investments that have a shot at beating inflation. Stop letting the scoreboard trick you. The balance doesn't matter. The purchasing power does. If watching your money slowly lose value in real time while the bank makes a fortune off it makes you want to actually fix your financial setup, hit subscribe. We break down exactly how money actually works, not how they want you to think it works.